Welcome to episode number 202 of CXO Talk. I'm Michael Krigsman. I'm an industry analyst, and CXO Talk brings together the most interesting, innovative business people in the world to discuss disruptive ideas and the impact of technology on the organization. Today, I'm speaking with Oliver Bussmann, and we're going to talk about blockchain. We're going to talk about fintech startups, and we will talk about financial services. I've known Oliver for many years. He is a superstar chief innovation officer, and he's now advising large financial institutions on these innovative topics. Oliver Bussmann, how are you?
Good. Thank you so much, Michael. Thank you so much for having me. Glad to be back, and thank you so much for the opportunity.
Well, Oliver, it's great to see you here on CXO Talk once again. The last time we spoke, you were the global CIO for UBS Bank, which of course is one of the largest financial institutions in the world. Since then, you have formed your own advisory firm, and tell us about your focus, tell us about what you're doing.
Yeah, I'm helping financial service companies, high-tech firms, IT firms to stay ahead of the digital disruption curve, because the industry, especially the financial service industry, is going through a lot of disruption, helping them to identify those mega trends, impact, help them to do the orchestration meaning managing the innovation from research, identifying what are the priorities for a company, how to do the ideation, how to invest in certain ideas, test drive them, and integrate them in their normal product and lifecycle management, helping to do the orchestration and help them closer to the fintech ecosystem, which is a lot of startups, government, university, research institutes. So it needs orchestration like in other industry, and leveraging my experience over the last 25 years in the high-tech industry, and then also in the financial services industry.
So when we talk about financial services, what does that encompass?
No, it's a wide range, different sectors. I've been through all sectors in the last 25 years. That's my one of my experiences, benefits is from insurances, life, P&C, property and casualty insurances, to all sectors of a bank, from asset management, retail and institutional asset management, to the retail banking business, helping the consumer banking business, to the wealth management, the high networks, ultra high networks, to serve them, to the capital market, corporate banking, commercial banking, etc. So it's a wide range of lines of businesses, different needs, different level of development over the last few years from a maturity level perspective, and I would say the industry is in the middle of a major big change here.
And what are the changes that are taking place in financial services right now? We're all exposed, of course, to online banking, but it goes much deeper and much farther than that.
Yeah, it's multiple dimensions that a financial institution has to cope with right now. It's definitely after the financial crisis 2008 2009 is the amount of regulation is significant, I would say. That to protect the consumers after 2009, there are a lot of new regulation in all jurisdictions, put a lot of effort and controls, risk management, compliance, to avoid any misconduct in the future. And to give you data points, today, usually large players invest between 50 and 60% of their IT investment, change the bank, just to stay in line with the regulatory requirements. That is significant higher over the last 3-4 years, and absorb of a lot of potential investments that you need for new services, new products to implement, improve certain customer services. That is now absorbed by the regulatory requirements. And there is definitely also then the push for standard software, because if you have a global business, you have to stay in line with those local requirements, regulatory requirements. So the regulation is a piece which will stay. I don't see that amount of investment required will come down. The second is definitely consumer behaviors. The millennials, everybody has a different preference now to access information, making decision. Now there's a different patterns. Now the generation that is now becoming high networks, they don't want to go to the branch anymore. They want to talk to their financial advisor over the phone or video. They want to have automated information. The decision-making process is differently. So the consumer preference, how that gets like to be served, is a middle of a big change. The third dimension is new technology. We are going to another major change, even bigger than the internet bubble, the first one, 2000, 2002. There's significant venture capital and resources coming into the whole innovation, the startup community. I started at UBS a few years ago. The VC spend, venture capital spend, was at that time $3 billion. That number is from 2013 up to 2015 up to 20 billion. And the projection for this year, this will even go up maybe to 24, 25 billion. So that short period of time, and if you compare that with the internet investments 20 years ago, there was 500 million in 1995 spent on innovation in internet-related companies. You see the amount of resources and capital coming into the environment. And then from a macroeconomic perspective there is significant pressure on banks, especially European banks, because there is limited growth opportunity. So if you cannot grow because interest rates are low, and the transaction volume is also because in the market of uncertainty is low. So with the revenue pressure, the pressure even on the cost side is going up significantly. Cost side meaning your cost income ratio is under pressure compared to US banks. US banks are at 55% of your cost versus revenue. Most of the European banks are over 70%. So there's a significant pressure on those banks to be very careful to reduce your operating expenses, which has also an impact on potential investments going forward. So it is a constrained and stressed environment, and the new technology is even triggering, from my perspective, even bigger, significant change.
So the financial services industry is changing because of regulation. Then you have an economic environment which is putting tremendous stress because the banks have, in some cases, negative interest rates. Yeah. So you deposit money with a bank, yeah, and the bank loses money on that. And at the same time, you have consumer expectations that are increasing. They want greater flexibility, they want tools, they want the bank to invest in different type of relationship. And then you have technologies that are enabling a whole new set of competitors. So is that a reasonable summary of what's going on?
Yeah, I think we're going to a major storm here, from my perspective, and which will change also the banking structure, the structure of the industry, the market structure, because there is a belief that business models will change. Business model that banks have to think about what kind of business model they want to play with or be in. That means there's a discussion about banks will focus on the client relationship and advisory role, and will be open for product providers like Blackstone is a product provider. They integrate in them, and then there will be transaction champion that they are able to, with large scale, to process the amount of information, etc., to leverage the economy of scale. So there could be a different market structure going forward, and then you have to think about how you want to play. Because, for example, if you want to integrate different product suppliers, it means an open architecture, open APIs. You have to integrate different other suppliers, and that has an impact on the way how you operate and how you drive your applications, your architecture.
So this intersection of the changing consumer expectations combined with shifts in technology And therefore, the emergence of new business models is very fascinating. So can you elaborate on how these three, how changing expectations of consumers and how the shifting technology forces the banks to change? Why does that take place?
Yeah, first of all, I think there, as a consumer, you're already have a different user experience already today in other industries. To from a music perspective, e-commerce, and you apply the same expectation now also towards the banks, and they are now coming out of the fintech community, new service offerings, and what I see is that first of all, startups going after a portion of the value chain. So they're not going to replace the entire retail bank. They're focusing on part of the value chain from the payment area, lending, the whole investment, the investment management perspective, then the whole crowdfunding, providing capital. Those are major areas of disruption that startups will pick one portion of that value chain, try to leverage new technology, from mobile, from artificial intelligence perspective, try to digitalize that piece as much as possible, and try to also provide a different user experience. So everything should be accessible over the web, internet, and those startups try to, like in the robot advisory business, a business that is now going after a retail customer that usually are not getting sophisticated investment advice. And those robot advisors are able to consolidate your assets across different banks. Usually a family office, very sophisticated, does that, and now they do this in an automated fashion. So you have everything in one place, and then based on your risk profile, based on your desire to what kind of return you want to see, they see if your portfolio structure the right one, and then provide information how to rebalance that. And so that the whole user experience to do account aggregation, advice, and then provide information alerts over the time. And then the potential next generation of robot advisor embracing artificial intelligence to run their quantitative models, how to see the market will play out, and based on signals, based on their due rebalancing of the portfolio, that usually achieve really a well-educated and experienced chief investment officer will drive your portfolio composition, will leverage more technology going forward to drive up performance. So right now it's more convenience, easy doing of business. And over time, with new technology like artificial intelligence, you will see even the investment performance could be heavily driven by engineers, scientists that have a better understanding about how the market is reacting, and try to understand the drivers and model them in your quantitative model. So the entire business is getting disrupted, and this is now happening in the payment business, in the retail business. It's happening in how you get your credits and loans in the lending business, how you do provide capital for SMEs or small businesses or startups from a crowdfunding perspective. So there is a significant activities out there, and from that perspective, is already changing how you do business today, and banks now try to work with startups, and startups also try to partner, which was not always the case a few years ago. So, and I think this collaboration model is now coming more and more to play.
Now, some of the technologies you mentioned, but we all hear about blockchain. And of course, that's not the only technology that's changing banking and financial services. But tell us about blockchain. For those of us who don't know, just give us a very brief introduction. What is blockchain and why is it so important?
Yeah, and it's for me, it's a great experience in discovering the blockchain technology in an early stage. It's remember, Michael, we've been through the mobile enterprise maybe 6-7 years ago, that consumer devices in the mobile space came up, and then at that time at SAP we realized that it will have a significant play in the enterprise too. So we learn over time to discover those mega trends and see an early stage the potential, and then put the best team on that small team to just explore, to understand, and then become a leader in those kind of areas. That happened during my time at SAP, very successful, embracing mobile devices and tablets, early stages application. And then also here, let me share the story happened to me also, that I discovered, or we discovered, that blockchain is a significant role, because we got approached by an entrepreneur in Switzerland that approached us and saying, we can do FX trading, foreign exchange trading online, and we settle everything in real time. And usually if you do stock trading, it takes at least 2-3 days to settle. That exchange of cash and the security takes time. And this immediately, bold statement, we can do this in a few seconds, everything is settled, and the cost of doing of business will be low, plus the real-time execution will reduce operational risk capital will come down. And then we said, that could be, it's hard to believe. And then we discovered that the underlying technology of Bitcoin, the blockchain, is the key driver, because it's a no-no for most of the banks, and still Bitcoin, with their reputation, to even discover that and discuss that. And then we discovered that the blockchain technology based on Bitcoin at the end is a major simplification of our business. And let me explain a comparison is. Today, if you do a trade, it goes to different parties. You sell something, they have a buyer, and there are different banks in place, stock exchange, clearing houses. I would say between at least almost 10 parties involved, and they have to reconcile, where's my business? They have to exchange messages saying, where's my cash, where's my security, is it on the right way? They have to reconcile. It's a major effort to do that. And blockchain at the end, in a very simple way, is you store information over the internet that the involved party can point to. It's almost like a reference, a database reference that point to. And there is a mechanism that if you do a transaction, it's first of all locked and it's recorded. You cannot manipulate that. Plus, there is a software at the end making sure that this transaction only is unique. Verifies that. So you don't need a third party to verify your transaction. The software is doing that. So that business logic is part of that ledger. And at the end, the whole messaging goes away. You have a direct impact. Certain parties not anymore necessary, and so complexity goes away. The speed of doing business is going away. Plus the accessibility. Blockchain and Bitcoin is public ledger at the end. Make it easy to access that information from everywhere, because it's not anymore stored behind firewalls. It's accessible for the different marketplace, and there's encryption in place to make sure that only the relevant parties have access. So it's a game changer from my perspective, and game changer not only for the financial service industry, for insurance, for trade finance. You see this also for the Internet of Things. Now you have a lot of information, sensor of information. And what you do, there must be, if certain events happen, then there should be like a smart contract that you can action on that. It's like you have sensors in your fridge, and the fridge is empty. What do you do then? And there should be a clear definition. If those kind of events are coming in, triggered, then you do certain, you buy something online immediately. So that technology, and this is the reason why certain high-tech firms like IBM, for example, and other firms see this as a combination from blockchain and IoT, building dedicated businesses to make it happen. So what I'm saying is, it is like the internet 20 years ago, a game changer that has a major impact on the financial service industry, and I believe also in government, healthcare, supply chain management. Every time if you have multiple parties involved and their needs be synchronized, that's the way going forward.
Are there examples of banks or other large organizations that are using blockchain in a
Yeah.
meaningful way today, or is it too early yet?
No, I think that you see the first use cases coming up. Use cases in general in the fintech area, the payment area is a target segment, because payment there is the business is profitable. There's a lot of profit pools. There's a need to simplify that from a user experience perspective. And the use case that I think will come through at an earlier stage is the cross-border payment. It's complicated because you have to go through a lot of banks, central banks, to do those cross-border payments for retail and institutional clients. It takes time, and it's an average roughly you pay $25 for an international transaction. And parties like Ripple, for example, other ledger providers, they're very simplifying that, and there is a consortium of 6 banks working on that. That they're using already the technology for their cross-border business within the bank. The next step is they build a network to exchange those transactions, and the infrastructure will be simplified with that. Speed is different, and then also the cost to market, because the projection is that a transaction that will cost today $25 will come down to less than $1. And
Wow,
then
amazing.
that's exactly is a major change that will drive that. Because if you're an institutional, if you're corporate and doing international business, and you sit on stage with your corresponding bank and saying, I'm paying $25 on average, domestically I'm paying less than $1, there is a clear demand to bring it down below that. So, but then you understand the revenue is coming down. Banks that are able, early mover and adapting, will have a chance to get more market share. So if you're not part of the train, it could hurt you significantly.
We have a question from Arsalan Khan on Twitter, and he asks a really interesting question. He says, what about the ability of these financial institutions to absorb new technologies and changes created, business models and so forth, created by technologies such as Bitcoin? What about that? That's a really big deal.
I think, first of all, because these changes will not go away. So the fintech changes, new technology coming up, new services. So as a bank, you have to prepare yourself for that. And it's almost like you establish an R&D process, which I did at SAP and then also at UBS, to do this. It almost institutionalize this. That is your day-to-day job to understand, what are the new technology, new trends in the business, in those markets. Number 2, to see what's your own priority, and define what is your focus area. Is it in a peering area? Is it in scoring? Is it in investment management, etc.? And then you help the business as a CIO how to develop ideas. It's all about is what kind of ideas can be leveraged, can be built on those new technology. Then you do a competition like a VC fund and help them. The best ideas should be test drive in a lab or in an accelerator, an incubator. You have different to do. And then based on that, you see, is there an impact on your product and service life cycle? So at the end, the organization have to get closer to that ecosystem of startups, regulator, etc. Expand the area of your solution space, no? Because if you have limited visibility what's going on in that space, you start just do incremental changes. And in the moment you have a view on what's possible is, and if you provide an environment that you can, I would not say play, but test drive and understand and expand your creativity and how this could influence your own product portfolio, new products, how existing products can be evolved, etc. That is a competitive advantage, but it needs, based on my experiences, orchestration. It needs clear and working environment that's allowed to fail failure is important. And then the best ideas, like in venture capital, the best bets will take off and will have a significant contribution. So what I'm saying to you is, it doesn't help you if you have a fancy lab. Is the business has to be there. There has to be a clear way how you do R&D, like pharmaceutical, like other industries too, as part of their significant R&D investments.
But how does a bank, or this would be true of any large organization, how can they organize themselves to remove or put aside, and I'll say this, there's a big company kind of arrogance sometimes. And you say, well, we're the large company and we know best. And so why should we listen to that tiny little startup that's, in a proverbial garage? So how does a big company overcome that kind of attitude in order to really get the benefit of the innovation relationship that you're describing with startups?
No, I think first of all, it needs that you spend time with the community, the ecosystem community. My experiences is the biggest impact that you have is if you bring the executive team into those startups and give them full insight how their service offering will hit you maybe today or the next few years. So I'll give you an example. If you go to these investment advisors, these automated ones, road advisors, and then if you understand how they try to generate leads, how they manage a lead and convert into a customer, how they serve those ones, what different roles they have, what kind of tools they have. Today you would say, it doesn't hit my business, my high networks, ultra high network business. But the average age of those high core affluent customers are 40, 42. And you can set up the clock that they become high net worth customer with $1 million and more assets in 2, 3, 4 years. But then they have a clear preference how they get served. And so you can already imagine that the way how you provide services over time, they will get there. Sure, they have to get more sophisticated products in the lending business and portfolio composition, etc. That's clear. But what I'm saying is, you can see that the way how they serve clients is for their customer base, and that customer base will grow. It's a major change.
So that it's very interesting. So the client relationship seems to be a fundamental factor in this transition and underlying both the change in business models as well as the relationship that a large organization like a bank might have with a startup. So that client relationship seems to be the constant driving force, or one of the constant driving forces.
Yeah, exactly. Because the generation that, sticking to the wealthy, potential wealthy clients going forward, they're used to leverage technology as a consumer to the maximum. You organize your life around apps that helps you to organize your day-to-day life. So that's the expectation also going forward, is that the way how you get access to financial services, to products, etc., has to be also well integrated in your day-to-day life, and should be accessible, consumable, easy to make decision that you used to also in the e-commerce business. And so you're absolutely spot on. That change of preferences and customer experiences and expectation at the end has a major impact in the customer interface. The customer experience is important. And then also the level of automation. Also, if you, for example, go to a branch today, and there's a big change, if you want to open up an account, the future is, and it's already happened in certain countries, that you can do even video onboarding. Now you call in, they check your passport, etc., and other ways, biometrics, and you can open an account in a few minutes instead of days. And effort is low. Then the next big wave will come with the legislation in Europe, with it's called PSD2, as a payment directive, that allows the consumer also give access to third party to your accounts. Now, in the US, it's almost standard with Yodlee. They have access to, if you use those services, access to your different bank accounts. So what happened in starting 2018, there will be more transparency. Transparency, how is your different accounts, the different banks performing from a cost perspective, from a portfolio performance perspective. So the level of transparency, because those interfaces will be then open, and comparison portal that you see already in traveling and in other services will have access then also to your banking business. And then you have a different benchmark, how well you're performing compared to other banks. And then if the ability to change your banking relationship is then also being simplified, relationships that are out there for 12, 20 years in average could change, because the level of transparency and the easy doing a business and changes will trigger a change of customer behaviors.
Arsalan Khan from Twitter again has another really interesting point. So when you talk about technology and it's the combination of as you said earlier, the technology, government regulation, and consumer behavior and expectations that are driving these changes in financial services. So inside these banks, how does it work? For example, you were a CIO in a number of times in very large organizations. And so what's the relationship between the technology folks and the business folks and IT, and how does that all get sorted out in the right way? What's the right way to handle that?
No, I think what you do is, first of all, my experience is you have to align the business agenda. I mean, where they want to be in the next few years with whatever you do on the IT side. So you cannot run your IT planning decoupled from what the business is planning for the next few years. So alignment of what's the business strategy, what is expected, what kind of capability you need to be successful, and then identify where are the white spots or where are the spots of complexity, and then mirror this into your IT strategy and plans is absolutely necessary. Number two is the speed of change, and the different speed levels. If you everything customer related, customer touch points. Second area is that you have a differentiated added value services with IP, intellectual property. You try to spend more time with IT and business resources together in an agile, more closely relationship, and you try to do this in a more fast-moving, agile way. The normal, heavy lifting is more in a factory, in the standard way. So there are different speed level how you embrace the change, on the customer interface side, on the side that differentiates you, that drives revenue, and there are the normal activities. So what I'm saying is alignment of where's the target state, what does success mean, and then also the way how you collaborate from the day-to-day portfolio perspective is absolutely required to make sure that you're not working in an isolated way or decoupled from each other.
What are the characteristics of organizations that do this well? Because in theory, what you're saying obviously is right, but it seems that many companies have an extremely difficult time doing this.
Yeah, it needs starting. For me, is that starting from a midterm planning perspective, that the business strategy and business development organization is very close to business and the IT organization. So you don't do separate planning between the two organizations, and you bring this to an organized, coordinated effort and do a cross checks. Is it Is it really, are those parties in sync? Now that has an impact on the financials, etc. So there's some that are companies out there that is doing well, and that's my experiences. You need this kind of dialogue on a regular basis, and that should be reflected in the way how you do plan and how you build your portfolio.
Is that fundamental to the job responsibility of a CIO to be able to do that?
Yeah, absolutely. Because if you just do your IT plan in an isolated way, yes, you can drive impact, but the impact that successful CIOs measured by is how's the business impact, how the company is doing from a revenue, from efficiency point of view, from a security and from a risk perspective. That's a measure. The second is, I believe also the CIO has to be champion also for innovation. And innovation in a way that you become a really expert what's from a technology perspective is available out there. You are a facilitator, how you bring the business closer to that startup community, for example, and help them to embrace those kind of possibilities. So because I'm a strong believer that the business has to embrace and be in the driver's seat, because at the end, if that knowledge is with the business as a product owner, a service owner, that is the highest maturity level. If it's just in IT what's possible, then you do this in your own governance for your infrastructure, whatever is under your control. But in the moment it crosses the business line, you will have a hard time to get buy-in and support. So my preference is being an innovation champion and facilitator, but business ownership, you help them to build up those kind of capabilities.
We have just about 5 minutes or so left. And what about on the business side? I'm very interested in your advice for how companies can take best advantage of strategic IT. Again, my point of view is that for many organizations, they want to do this, but the relationship is quite dysfunctional.
Yeah, I think you're right. I think first of all, you have to look at this as it's a partner, because if you look at certain banks like Goldman, they have a significant spend of a portion of their operating spend is IT. And so they believe they are a tech company, and I think that's the direction that the industry is going. So you believe that your critical success factor is technology.
So
that's for me the fundamental belief, and that means also as an business executive, you have to invest time and you have to be up to speed what's going on in that space. You don't have to become a tech expert, but what is possible from a technology perspective is absolutely clear and necessary. On the other side, Michael, the risk is if you just only talk tech, you miss an opportunity to question your current business model. Because the worst case is you go for state-of-the-art software, and you've been through this with a lot of standard software players. And if you don't spend enough time and what could look like, how you do business, how you operate, what kind of complexity you can reduce, the same way how you operate today, the same complexity, the same challenges will be mirrored on new software, but you don't leverage what's state-of-the-art, how you run business, how you can leverage the benefits out of that. So there is a frustration level if you go straight into tech implementation that is just IT is doing. You need time with as a business leader to think about how my business will change. How many can I reduce my booking centers? Is there a way new products will come up? Is there a way to reduce complexity from a process, product, client perspective, and spend significant time on that to challenge this, and then use this as design principles to implement new software. And if this kind of pre-work is not there, yeah, you see changes, you see benefits in using new technology, but you not leverage that to the fullest extent. And that's something that I believe in the future, understanding how to drive change, understanding what is possible in the marketplace, spending time on that, and have a discussion on the executive board level, and then also on the board of directors level, is I believe necessary, mandatory to stay competitive going forward.
That's really interesting to look at the CIO role as a foundational skill, so to speak, is understanding how to drive change.
Yeah.
And it makes perfect sense.
Yeah.
What about the, again, we have just a few minutes left, but while you're here, I want to really pick your brain on some of these topics. So what about the relationship between CIO and titles like Chief Digital Officer? How does that play out?
No, from my, I've been through sort of in different companies, etc. Chief Digital Officer and the Chief Information Officer, they have to work together. They're depending on each other, and I believe if you're Chief Digital Officer and believe that you can do the change without IT, it will be very, very hard. If you have somebody like a Chief Digital Officer that understand the business processes, the business going, etc., and as an IT head, if you can leverage that, that's a perfect spot that you want to be in. So my recommendation is definitely you have to look at this as a partnership. If you run this in an isolated way, it will fail.
And changing gears here, but just as, again, we drive towards the end, changing gears, what advice do you have for startups who want to do business with larger financial services banks, insurance companies, what have you?
No, I think that's a very good question, first of all, because I got this a lot, because I do mentorship. I mentor startups. I'm part of the Level 39 Fintech Accelerator in London, and spending time with the startups there and give them advice. And my first advice is yes, good understanding about the technology is important, but business domain expertise is critical. So if you talk to bankers, if you don't understand how the business is working, products, processes, etc., if you don't have that expertise, there's a communication breakdown, because you talk tech versus how this could help my business to improve, and finding that the mixture that you need, sure, absolute tech engineers, scientists, but also building that expertise is a critical success factor. That's my number one advice that I did also in Financial Times or Financial News articles, that I believe domain expertise, because it helps you to sharpen your value proposition. What's different? Why should I work with you? And you have maybe, I would say 20, 30 seconds time if you approach a business executive to convince him to spend more time with you. And it's all about how does it fit, or is that from a business term perspective, business language perspective, what is the biggest value in working with a startup?
So for the startups, you're saying, yes, you may have great technology, but you need to be able to talk about that technology in terms that the bank on the other side cares about. So maybe in terms of their customers or what have you, customer relations.
Yeah, exactly. And this is the reason why a lot of banks, also UBS, is very successful, did open innovation challenges and competition, inviting them. And the best startups, they get mentorship or training and how they can improve their value proposition, their business plans, etc. So it's not only a tech play, it's the way how you position the foundation of a firm at the end that you work on, and how you manage the relationship with your clients. And so that's the reason why a lot of banks are investing in those startups, or investing time and resources, because it would be a mistake that you have a brilliant technology idea, and you're not able to convince the other part, the customer, that that will have a significant impact on improvement potential for your business.
I like that. No matter what the technology, it's not just a tech play.
It's not a tech play, it's a communication like between me and you, it's between people, and it's a people business. And if you're able to communicate this, if you talk the same language, it's a sender receiver, you speak the same protocol, then the probability that somebody is supporting you and would like to work with you is pretty high.
Well, and that for sure are words of wisdom from Oliver Bussmann. Oliver, thank you very much for taking the time and speaking with us today.
No, thanks so much for having me, and thank you so much for the great discussion today.
We have been talking with Oliver Bussmann, who previously was the CIO of SAP and then the group CIO at UBS Bank, one of the largest financial institutions in the world, and today is advising financial services companies as well as startups on how to evolve together and work together. You have been watching episode number 202 of CXO Talk. You can check us out on the web at cxotalk.com and see our episodes at cxotalk.com/episodes. We have 2 shows next week. Please join us. And a special thank you and shout out to Livestream, because Livestream provides our video infrastructure, and man, they are great. And I mean that. Thanks for watching, and we'll see you again next time. Bye-bye.